Great, thank you, ladies and gentlemen. Many thanks for coming along today. My name's Peter Allen, and I'll be your chair for this meeting today. I'm an insurance partner with Moore Stephens, the accounting and advisory firm. In a minute, I'll introduce our four speakers, but before I do so, I thought I'd offer an observation, personal observation about the MGA market. I didn't personally start life in accounting. I started working life as a Lloyd's broker in the old room over the road in 1982, and on-the-job training involved following an old broker around the room. The office legend, or at least his own version of the legend, was that one day he had found himself sitting in front of an underwriter in Lloyd's with his usual mixture of assorted non-marine risks. He tried a number of ploys. Would the underwriter like a small line on a ton of frozen bull semen in transit? Sorry, sir, we don't do transit risks. Would he like an even smaller line on the Aga Khan's jewellery in vault? The underwriter asked, could I see the physical security report? It's the Aga Khan, sir. He keeps all his stuff secure. We don't do very high-value items without a surveyor's report. What about a 192A extension for a construction site in Cullum Street, just round the corner? Is there any piling? I don't think so, sir. And office legend had it that you could hear the piling from the room. We don't write piling risks. After about 10 minutes of this, the old broker took the last slip from his case, but instead of putting it in front of the underwriter, he tore a very, very small piece of grey card off the corner, about the size of his index fingernail, put it in front of the underwriter and said, would you like to write down on that, sir, the classes of business you are prepared to contemplate underwriting? I tell that story in order to illustrate well-known cultural differences between the average broker and the average underwriter. On the one hand, brokers, entrepreneurial, always looking for the placement, positive, seeing the upside, largely unworried about underwriting detail. On the other hand, underwriters, choosy, worried that a good risk not written is always better than a bad risk written, husbanding capital, analytical, capable of negativity. These characterisations are crude oversimplifications, but having worked in both broking and underwriting environments and having both as valued clients still, I don't think they are totally unfair. The point, of course, about the MGA model is that it's designed to encapsulate the best of both. The entrepreneurialism of the broker, the eye for the product opportunity, the positivity of that environment, getting it done for the customer, all put together with underwriting skill, the underwriter's care about the judgment and pricing of risk, the building of a portfolio and the technology to back it up. That is the ideal, and that is the business objective. Does this work? Surely it does work if the management work hard to compensate for potential gaps in the business model. A broking style of management in an MGA works fine if the business cares as much about underwriting performance as do the capital providers. Well-controlled underwriting systems work well if they support a positive and entrepreneurial approach to risk sourcing. It follows that a key component of that success is to develop technology solutions for the MGA model that support both accurate and well-controlled underwriting risk selection and allow for the entrepreneurial ambition to innovate and grow. Our four speakers today are each involved in that mission, and it's my pleasure to introduce them. Charles Rowley will speak first. Charles is a founder of DA Strategy, and he has 23 years of experience in the delegated authority market. At Catlin, he led the team that helped underwriters grow the delegated authority portfolio from 80 million GWP, US dollars GWP to 1.1 billion, and expanding the cover holder client base from 120 to over 800. Charles chaired the LMA committee, which helped develop the vision and key priorities now incorporated within the London Market Group Delegated Authority, TOM. Nick Ferrier has worked in the London insurance market since 1992 across underwriting, analytical and regulatory roles. He's been head of business development at Pioneer Underwriters for over 4 years and is responsible for developing new business opportunities as well as capital placement and marketing of the group. My colleague David Sweets is a partner in our insurance technology practice and one of the founders of the Rulebook product suite. Over the last 12 years, David's overseen the development of dozens of data analytics, underwriting and distribution tech projects in the London market. And this includes the partnership with Pioneer since it began in 2015. And finally, Stefan Nadarajan has over 20 years' experience delivering technology, business change and transformation solutions to the insurance industry as a supplier, consultant and now at Pioneer. Charles.
Thank you very much, Peter. What I thought I'd do today is to sort of hit a few key themes that we're currently seeing in the delegated authority market around customers, carriers and regulatory requests and requirements, a little bit of insurtech disruption, and then some thoughts on how we might address them. Okay. I'm going to do this by bringing a few stories from other industries, and then my colleagues are obviously going to add far more detail than I can to that. So, customers. I think we'll all agree, whether we're the customer or whether we're dealing with customers, that they're becoming more and more demanding. Better service, I want 24/7, I want to be able to do this on my mobile phone, I want to be able to do it, at 11 o'clock at night, whatever it might be. And I want better prices. I only want to buy that piece of a product that I really need. I don't want stuff put in there that pads it out, doesn't really meet my needs. So people are looking for those sort of customized products and things. And, my wife's like this. We go along to a restaurant and we'll sit down, probably not often enough to the restaurant, that is, but we do. And I'll order steak and chips, and she'll say, yeah, I'll have the same, but instead of chips, I want potatoes. I'm like, okay, fine, fair enough. And instead of peas, I'd like the salad. And then that salad dressing, actually, I'd like a different salad dressing to the one you normally use. I want that in a bowl on the side as well, so I can put the right amount of salad dressing on my salad. Yeah, you guessed it. She is from America. And, that's the sort of example that I think people want to see from their insurance providers as well. So it's a question of, mass customization. It's not we have standard products, we need to push them out. I think we need to be thinking about how can we customize what we give to our customers so they get exactly what they want. And I was thinking back around other industries in this space. I recently read a book about Procter & Gamble and how they've dealt with this sort of situation when they first started to notice it back in the early 90s. And what they did was they obviously had this issue of many more brands, small brands appearing on the horizon and on the radar, and they said, how are we going to deal with this? So if we think of their challenge, their main distributors are obviously the likes of Tesco, Sainsbury's, Morrison's, those types of people. And if we think of P&G or Arla or some of the other big companies as a bit like carriers, insurance carriers, and we think of Tesco, Sainsbury's and those sorts of things as a bit like MGAs and brokers, then we can see some sort of lessons that we can use going forward. So again, coming back to, how did they start to think about how can I deal with these customers who are sort of spreading out? They're no longer just buying the Warburton's bread. They want some bespoke bread with seed on top and that sort of thing. They say, well, we need to understand those customers more. We need to get to know them. So what did they do? They reached out to the likes of Tesco, Sainsbury's and the others, and they said, we need to take some teams of our key people, our key product people, our key data people. We need to put them inside those Tesco offices. Or if we can't get an office space inside the same building, at least in the building next door. So I think you'll find right now that Procter & Gamble and Arla and people like that, they have people who are in the Tesco HQ in Cheshunt or the Sainsbury's HQs in Holborn. They're in the Waitrose HQs over in Bracknell, and they're embracing those stores and they're embracing their data, and they're helping and they're working with those stores to build the new products, the new brands, and the new ways of selling them. Carriers, Lloyd's, and regulators. I always think pictures say 1,000 words, and certainly around red tape, some of them are unprintable. So I think that I'll leave that thought with you. However, what I wanted to really focus in on here is data. So how many times have MGAs, cover holders and brokers been asked for more data? Oh, I just want one more field. I could just do with an extra MI report. And I think, if you haven't, then please contact me. I'll ask those questions. But, I think we've come across those issues many, many times over the last few years as more and more demands have been placed on our carriers by the regulators. And we need to be, effectively, seem to be bombarded by those requests for data. And when we ask, what are you doing with this data? Quite often it's, well, I've been told I have to have it. Lloyd's has said I must have that data. I'm like, okay, yeah, but what are you actually doing with it? And I'd like you just to sort of, hold that thought for a minute, because how many times have people in this room, primarily MGAs such as yourselves, how many times have you had a carrier who's taken your data, come back to you and say, actually, we've really thoroughly analysed your data and we think that there's some new products we could develop with you. We think there's an area here where we could work with you to either expand an existing product, develop a new niche, grow into a new geographic area. Could we have, say, a show of hands of anyone here who's had one of those sort of discussions with their carriers from the MGA side? Well done. Good. I'm glad you're on a panel. Good. So that's good in one respect, bad in the remaining respects. And I think, what I want to do here is think about, what Toyota did. As many of you will have read the book about lean manufacturing and the machine that changed the world by James Womack back in 1990. And he, explains in there all about lean production and about how the Toyota and other Japanese manufacturers and people work symbiotically with their parts providers and their suppliers when they're putting new cars together. So how do they build a new Prius? Or how do they tap into a new marketplace? Well, they don't just say, right, here you go, here's what we're designing, here you parts suppliers, you need to just give me these sorts of parts. They go to their parts suppliers and their other suppliers, and they go to them and say, right, I need to get a better battery, I need to have lower powered lights that I want to use. I need to have better tires that have lower rolling resistance. I need to have improved drivetrain efficiency, etc., etc. And they use the suppliers and they work closely with those suppliers in developing new products. So they package up what their suppliers are giving them into a product that the customers need. And I would like to argue that that's something we need to do more of as well. We can get a better consumer product, and we can actually achieve what car companies can do now, which is you can log on to their websites often and you can choose the colour, the type of upholstery, the engine size. You can choose all of those sorts of things. Now, it's still not perfect, but they are giving us a heck of a lot more customization than we as customers were ever able to get in the past. So insurtech disruption. There's a lot of talk about insurtechs. There's a lot of noise about insurtechs. Many are fascinating in what they're proposing. And most of them, in my opinion, won't stand the test of time. But what they do, or at least in the main, what they all point towards is what are effectively ways of meeting our customers' needs better. How can we serve customers better? On-demand insurance, daily insurance models, 24/7 service and customer portals. I had a sort of interesting situation myself recently, and I would guess many of you parents, so this story might resonate. My son, who's 19, passed his test, and it was great news. He was really thrilled. He was grinning from ear to ear because he'd actually done something that his older sister hadn't. So that was a big hit for him. She wasn't so impressed, as you might expect. I thought, great, that's great. I'll put you on, on my old, I've got an old Toyota pickup up in Cumbria. I'll put you on that insurance. It's not worth very much, so all I need is a bit of liability. No problem. So I look online, try and do it online. No luck. No, we don't like young people driving pickups. Okay. I'll try a broker. Oh, that's great. Yeah, we can definitely do that, sir, but only when he's 21. So I'm like, okay, how can I deal with this? So I check other websites, and they say, oh, only if over 25, the category of the vehicle is too high. I said, well, all I want to do is insure him for 3 weekends a year, which is probably when he's going to be using it. Not even Marmalade would come to the rescue. So I'm completely stuck. I have to go and buy another car for him, if I want to, that is, which I don't. So if I want him to learn to drive. So he's left in this awkward situation where actually he's better off not driving for 3 years or 2 years until he gets to 21, and then I'll go back and I'll probably be able to get insurance. Will he be a better risk then or not? He'll probably be worse. So why am I telling you this story? Well, I think, we're good in the insurance industry at setting out products. Here's our product. You should buy it. Or here's the rule. Until you're over 21, you can't have this insurance. Or unless your vehicle is small and less likely to do damage, you can't have insurance. We're good at setting rules and we're good at defining products. But we're not good at being flexible and agile and developing, the deep partnerships that we need to build on niche opportunities such as that. Now, I'm not saying a 19-year-old driving a monster truck is a great risk. But if anyone does have any ideas, I'd be very interested to hear them. So where am I coming from with these points? And I think it's probably fairly clear. I think we need to sort of come back to the partnerships and the data, and we need to think about, how can we start to use the data that we are gathering and developing, and how can we work with our carriers or the MGAs and the carriers together to develop out some of these niches to deliver on the customer requirements. So if we think back again to the retail industry and we think back to 1993 and 1994, there was a company created called dunnhumby, and they helped Tesco set up with their club card. They were the second retailer in the UK to set up a club card, and they developed that for Tesco back in 1994. And there was a very famous quote at the time from Lord Maclaurin in 1994, and he said, "What scares me is that you know more about my customers after 3 months of analysing this data than I know having been in the industry for 30 years. So I'd say we need to take that sort of situation and we need to develop some ways of working together with data. Carriers, brokers and MGAs to develop these new products, develop additions, expand into small niches and use the data quite simply. There's not, we don't need huge, great 3D algorithms and things like that to start to make money out of this data. You think about what Tesco do now, whatever it is, 24 years since they launched their club card. I think Peter was saying this story to me the other day. I go into Tesco, I buy some pet food. 3 days later, I get an email from them that says, "Oh, would you like to buy pet insurance?" I say no, don't think that's good value. 2 or 3 days later, you get another email and it says, "Well, would you like to buy some pet treats?" So they're using data very simply just to say, well, we can use that information that you bought pet food to offer some other products. And I think that it's those sort of simple things that we can actually start to do more effectively ourselves now. And if we just start gathering that with simple things, doing in simple stages like that, then we will actually start to build out our businesses and offer our customers better products and better coverage going forward. So I'd like to just sort of wrap up a little bit now with a short summary slide here. I think we, and by we I mean particularly carriers, need to think about being more customer-centric and need to work more closely with those customers. We need to use some of the insurers' techs as a bit of a burning platform to push us along a bit and for some ideas. And we need to develop out and spread out into those niches and customizable products to meet those customer needs. So I'd like to think of us as deepening the partnerships, and embedding ourselves a little bit more in each other's offices and continuing as businesses to offer more agility and more flexibility and accessibility using this data that we have and that we're not using at the moment. Thank you very much indeed. I'd like to hand you over to Nick.
Thanks, Charlie. Right, so I was going to tell a bit of a joke, but unfortunately, Peter, you skipped over your image of building the Lloyds in 1958. So if you just think of Lloyds in 1958, or just look at the room right now and picture that in your mind, and then I'll tell my joke anyway, because I've also found an image of a crowd of producers standing on fertile ground. A bunch of cows standing on pastures rich. And you'll notice there's a farming theme to a number of my slides. And that is largely because farmers have had to embrace technology to maximise their production, just as us, MGAs, are going to have to, and actually continue to do so. That idyllic image of those cows in front of that farm, actually those cows are wearing tags, they're being followed by GPS, the milk that they produce is monitored all the way to the supermarket. So technology is being used by farmers to build a data bank, a database of what's going on, and therefore maximise their output. So today I'm going to take you through some of Pioneer's operating model, some of the challenges I think we may face going forwards, and offer one or two possible solutions. So we operate a risk match model, like most MGAs actually. We provide a flexible matchmaking role between risk, that's produced through the through distributors, and our capital base, or our carriers. We provide that funnel that matches specialist risks to the most appropriate capital. That is our role. So how do we do that? Well, we have to do that by being relevant to our distribution. And effective distribution, in my opinion, comes with ease of production, i.e. we provide products that meet demand. We understand what our clients want, as per Charlie's point earlier. But it also means that we need to offer them low transactional cost, i.e. administration reduction, and we can do that through some of the techniques that David and Stefan are going to be talking about later on in their presentation. We're looking to complement our valued wholesaler relationships with local expertise. Key to Pioneer's strategy going forwards is to get closer to our local production source, have a better understanding of what they're doing, a better position to price the risk appropriately and pass that risk on effectively to our capital providers. And finally, innovation. So innovation is a often used word. In this context, it's about identifying new ways of transacting insurance risk, not just about producing new products. So not only do we need to be relevant to our distribution, we need to be relevant to our capital. And that means getting our capital our partners closer to markets and risk that meet their strategic objectives. And we do this through a couple of quite simple points, actually. We understand what their risk appetite is. That means we get to get closer to them, spend a lot of time with them, understanding exactly where they want to take their businesses. Well, having understood where they want to be, we then provide them with cheap access to the markets, i.e. cutting the barriers to entry. A traditional way of capital accessing markets is to maybe go and set a syndicate up or a new underwriting team. That setup is associated with a number of quite high costs, other barriers to entry such as identifying the right individuals, i.e. those individuals that can meet your needs. Using MGAs like ourselves and yourselves, they can get quick, easy access into those product bases. And actually, if it's not the right product base for them, they can exit it quite efficiently as well. Also, it's about delivering profitable growth opportunities. As an organisation that is seeking a profit, why would you operate with a business that just doesn't generate that return on equity that you require? And again, that's where we come closer to them in terms of understanding exactly what their ROE requirements are and identifying the right risk that can deliver that. So capital access to distribution. So Pioneer provides a number of entry points to our capital producers. Like many of you, we offer facilities and binders whereby carriers can support your underwriting. We also get closer to our capital base through offering other ways to access our business. As you're probably aware, Pioneer recently established Syndicate 1980, which accounts for approximately 50 to 60% of the MGA premium throughput. And capital providers can participate on Syndicate 1980, which gives them a portfolio level access to the businesses underwritten by the MGA. We also offer capital providers access via specific reinsurances of our underwriting facilities, either through participation on 1980 or through other carriers. And this gives them access to that business, but they might not necessarily be able to do so because they haven't necessarily got the right level of licenses or other barriers to gain them access to that particular business type. And we can do it efficiently through our position within Lloyd's. So the future, for me it's not changing what we do. It's actually all about enhancing delivery. Again, coming back on some of the points that Charlie was picking up. And this includes finding new ways to reduce costs through efficiencies, understanding changes in our markets, and delivery of effective products. Coming back to the farming theme that we started off on, just look at the way that the delivery of milk to the end consumer has changed over time. Before it would come from a milk churn, it might go through some country lanes to a distribution centre, put into milk cartons, and the consumer would have one choice, milk, probably full fat with a bit of cream on top. Blue Tits loved it. Now, you rock up as a consumer at your supermarket and you have a choice, full fat, low fat, reduced fat, even non-milk milk, which is made out of almonds. So I believe there's going to be a change in the capital landscape. Capital will be forced to seek new ways of becoming efficient. Looking at change in other financial markets, you've seen that already take place. So certainly after the stock exchange had its big bang a number of years ago, there's been a number of changes that have driven formation of portfolio management type mega blocks that drive efficiencies through things like higher transactional volumes, but with reduced expense, certainly lower margins, but again achieving the return on equity that their investors require. MGAs will have to provide specialist underwriting distribution to facilitate maximum diversification to those players. On that basis, dealing with mega blocks, MGAs also, I believe, will need to scale their businesses to remain relevant and stay in the game. Another farming analogy. Just look at the transformation of how harvesting of wheat has moved on since the 19th century, where it would have taken a long time through this very rudimentary harvesting machine to gather a small amount of wheat to generate bread that was sold in Tesco's, etc., to now where you have combine harvesters operating large fleets controlled by GPS, maximising the production. So we looked at the risk match model earlier. What does the future risk match model look like? Well, it's not too dissimilar. There's a couple of subtleties. The risks will be the same. I think delivery to the market or our capital might have some slight differences. In my opinion, it was going to be driven by efficiency, and efficiency driven by tranching of risk into separate categorizations, irrespective of the risk type. So you see a whole bunch of different classes of business. We'll use technology to tranche that aviation risk with that motor risk, with that casualty risk, with that FI risk into different levels of almost like security. So you have A graded, B graded, C graded, etc. We'll then transact that risk with our capital providers based on their risk appetite, which will provide a far more efficient solution for them accessing the marketplace and that distribution. And again, if you think back to that image I showed you of the milk and the supermarket, it just as a consumer has a choice of different qualities, so it would be our job to deliver different qualities of risk to that marketplace. So the future. So this is going to be my last farming analogy because it's actually my last slide. But we, as MGAs, are not going to change what we do. We're just going to have to work smarter and more efficiently to remain relevant to our distribution and our capital basis. Thank you.
Thanks, Nick. So I'm just going to talk for about 5 minutes or so about the relationship between Pioneer and Moore Stephens, the work that we've done together over the last 4 years and some of the technology projects that we've helped deliver, which we believe has sort of helped to enable some of the strategic growth that Nick was describing earlier. So over the last 4 years, there's been some 3 core platforms that we've helped Pioneer to deliver since 2015. We have a data analytics platform that we've helped them to build, some work in pricing and underwriting, and also looking at distribution of those products, both things that we've done previously and also some future work that we're doing with them as well. So in terms of the data analytical piece, as you guys will almost certainly be aware, Pioneer operate MGAs in both London and US. And really, as you would imagine, a key requirement is to have a single trusted source of data across those business units to bring together all of that information in one place and for it to serve up a range of different functions across the business. So everything from executive reporting to underwriting, analysis, claims, finance and compliance, all driving their key insights from the same sources of data regardless of use. That started in 2015 with the rollout to London, and after the establishment of the MGA in the US, that was brought into the platform as well. And as well as reporting and analytics, big focus is also in providing data for downstream processes to make those mid and back office processes as efficient as possible, be that actuarial reserving or feeds into the finance systems and processes. I think key point for Pioneer on these projects was their appetite to invest in these things at the early stage of their evolution as a business. We do lots and lots of work in the market where we are helping to address challenges that have come up from many years of lack of investment in systems and processes. And those projects are very hard to deliver because you're having to sort of patch and undo years of data quality issues and challenges associated with it. Obviously, from the Pioneer side, it was investment in these sorts of technologies very early on in their life to ensure that the technology was there as they grew and some of those challenges were nipped in the bud early on. So no presentation would be complete without a pretty dashboard. So we've got a view here of the sort of things that Pioneer will be looking at on a daily basis. This is sort of business performance across the group that gets updated every single day to understand how the business is performing across both London and the US. And exactly the sort of key metrics that probably everyone in the room will be keen to see for their own businesses. So then more recently, in the last 2 to 3 years, we've been working with the guys as well on their pricing and underwriting approach. So no doubt most of you in the room will rely heavily on spreadsheets to support the pricing and underwriting process. All of the challenges and issues that spreadsheets can bring to your business, thousands of different versions out there being used for all sorts of different purposes. And of course then real inefficiencies in the process where you're having to rekey all of that data into your back office systems for reporting, for credit control, for claims management and so on. So what we've been able to do with the guys over the last few years is to entirely remove that reliance on Excel as being the mechanism for pricing and underwriting business. Underwriters across all classes will now log into a single web-based technology platform, and that's how they interact with their pricing models. That's how they underwrite business. After a bit of a rationalization exercise recently, sort of 75 products down to about 40 products now live across, as I said, all classes of business, from simple slot rated commercial business all the way through to marine, aviation, property and everything in between. It's used as a bit of a differentiator in attracting new distribution partners and capacity providers, demonstrating that control that they have over the underwriting process, adherence to various binding authority terms and showing how they are demonstrating pricing control. Importantly, the platform is self-service. So apart from probably the first 3 or 4 products that we helped to build, Pioneer are completely self-reliant in the ability to build and maintain these products. So if there is a rapid change that is required to take benefit of a change in the market or a new opportunity with a distribution partner or capital provider, that's something they can do themselves without any reliance on us as a technology provider. And importantly, for those capacity providers, it's demonstrating that underwriting control. So to win new business, new relationships, by demonstrating that control, obviously there's huge benefit to that. So this is sort of the end result. Pioneer branded, web-based underwriting system for all classes of business that they log into to price and underwrite business through the system. So be that on the MGA side and also more recently on the syndicate side, being able to price and underwrite business without that reliance on slightly uncontrolled and difficult to use Excel spreadsheets. And then so finally, in terms of platform development, then moving into product distribution, a real key strength of Pioneer as a business. So a big part of this initially was to offer e-trading portals to quote and bind business through. Obviously, hugely efficient way of underwriting business if you can pass that workflow on to your third-party distribution channels, being able to offer higher volume, lower premium type products through those channels. And that can support all parties, so that can be directly to the retail brokers, but involving wholesale brokers, third-party MGAs, carriers in the process, managing all of those referral and declinature workflows to ensure that where business can be auto-quoted or auto-bound, it can be. But if someone else needs to participate in that workflow to review what is being offered or to change terms accordingly, then it can all support those various functions. And then more recently, as well as being able to offer sort of Pioneer or distribution partner branded portals, the ability to directly integrate those products into distribution partner systems and processes. And really that's, from a technology standpoint, echoing Charles's points earlier on getting closer to those distribution partners. And we've seen from projects at Pioneer and elsewhere, the ability to embed your products directly inside their systems gives them massive efficiency benefits and puts you in a position where you can differentiate very well against other type of portal technologies where they're having to come to you to price and quote business. So very similar to what was being shown before, but the person now logging into the system is either a retail broker or some other distribution partner. And just some slight changes in the user experience to really make it a little bit more recognizable as a B2C type site. So you're taking people through a stepped process where they're being guided through the broking and underwriting journey and being able to offer them quotes and allow them to bind risks without any involvement from the underwriter if it's inside the terms of their appetite. And then, as I said before, the idea of distributing those products via APIs. So Pioneer are loading products up into the cloud, making those products available to third parties, and then those are being accessed directly from third-party systems to, again, quote and price and bind business. So trying to take that intellectual property, access to capital that Pioneer have, and to directly embed it inside their distribution partners' systems and processes. And as I said, that is where we see a pretty significant move in the market into providing those sorts of capabilities. And then just before handing over to Stefan for the last bit of the session, just a couple of future initiatives that we're working on with the Pioneer guys at the moment. A few obvious buzzwords in here for you guys to look at. So the two real focus areas at the moment is around real-time data transfer to all people involved in participating in the value chain. And I know that no doubt you will have sat in lots of sessions where the blockchain term has been bandied around, and I think it's fair to say that there are certain uses out there at the moment where it's questionable as to quite why blockchain is being used in that way. But certainly our belief for MGAs in particular, who have lots of different distribution partners, lots of capacity providers, blockchain is an incredibly elegant technology solution to sharing data with those parties in real time. So that's something that we're going to be working on with the Pioneer guys in the future, is to understand how risks bound through the platforms that they've invested in can be automatically shared with any party, be it wholesale brokers, be it the carriers, actually be it a regulator. How do we share that information instantaneously in a way that everyone's got the same up-to-date view of risk information, and there can be no dispute in terms of what people are on cover for and what terms have been offered. And then finally, as with everyone at the moment, a very careful, watchful eye on the LM-TOM work streams. and making sure that as those work streams mature and as those offerings become widely adopted in the market, that we're ensuring that Pioneer are aligned to that and can benefit from those initiatives rather than being behind the curve and slow to react. Stefan.
Excellent. Thank you, David. So I'm just going to spend a few minutes talking about how Pioneer and the platform has evolved over the last few years, and then where I see the next couple of steps in our evolution taking us. What you can see here is part of our current processing platform, and over the last 4 years we've evolved from Excel-based rating monolithic applications to a platform that is scalable, transactional, and integrated as well. And I mean, the technology is the technology, but actually it's the way that we've employed it and the way we've worked with our partners that we consider to be the differentiator. We've taken two approaches. The strategic approach, we've got partners in the producer side, obviously the capital side, and also on the technology partner in Moore Stephens, that we're taking a long-term strategic view on. And with those partners, we're delivering short, medium, and long-term benefits. But on the flip side, we've got a different way of working with people and activities which are opportunistic. In the growth stage of any company, the growth really comes from step changes which are opportunistic and are taken as tactical activities with tactical partners. And the way we've engaged with those different types of people differs and works well for everybody involved, I think. So as an example, with our strategic producers, we've got an MGAA producer in the US. We actually initiated a piece of work and we instigated that to integrate their policy admin system with our online rating platform. We actually got them, their technology provider, Moore Stephens, and us in a room together. We were very transparent about what everybody was trying to achieve, understood what every party was going to try and achieve and what success would look like, and then we drove the delivery of that with our producing partner. And it's that transparency, I think, is a theme that you'll see, you've heard obviously with everybody else, and that you'll see going through this deck as well, because it's the transparency that provides the trust and the comfort for the capital providers and all the other participants in the market to trust you to do the work that you're doing. Tactically, we have activities with people that we perhaps don't initially have a strategic partnership with. And anything that's opportunistic, the main driver is speed to delivery. And the way to maximize speed to delivery, we found, is by trying to find a commonality of purpose amongst all the parties. So we have had opportunities where we've got all the producers, all of the technology partners in a room together, but actually we've then worked on finding what success looks like for each party and finding a common success factor which we can then move towards delivering. So it's not about removing the rigor of delivery of solutions or product design, but it's actually trying to get everybody to understand what, I suppose in Silicon Valley terms, the minimal viable product is. But for us, it's an insurance product and how we deliver that. And actually, it's driving an efficiency through the way we work with people as well as the technology that is important to us. Where does that take us? Actually, as an MGA, I see we're perfectly positioned to add value to all of the participants in the value chain. We are perfectly positioned to provide data transparently to capital providers, to our producers, the wholesale and retail brokers if appropriate. And we're actually well positioned to augment the data that they're providing us when we're pricing products. And that augmentation of data is something that we do either calling Experian, or we use calls to look up things like licensing information for healthcare facilities in the US, and we can provide that data back to the producers so they get a better understanding of the kind of risks that they're writing to us. Obviously, we can provide timely information to our capital providers for exposure management. And it's that transparency, again, that gives the partners confidence in using us and actually transacting business with us. And another key thing is that we're technology agnostic. So very often suppliers require producers to log into their portal to get a view of their portfolio and have very prescriptive ways of providing data. But working with Moore Stephens, we actually have a more nimble, agile approach. You know, our online rating platform is web-based. It can be accessed through APIs, web services. We can provide the data as a distributed ledger. But it's the ability to react quickly and not necessarily react to the immediate market trend, but actually be a bit more circumspect and react to the trends which are actually going to give us a commercial advantage, and do that quickly is the benefit we have with the kinds of relationships we have with our producers, capital providers, and with Moore Stephens. That transparency also works for our underwriters. So our underwriters see real-time or timely information about the kind of risks that are being written, which means allows them to underwrite by exception, focus on the risks which they will see that either make or break a portfolio, focus on portfolio management. It also allows them to go out and talk to their producers and their distributors to understand what kind of products they're seeing a demand for. And our producers are the people who are closest to the customer and have got a best understanding of the types of products that people are looking for, and also the way in which they should be delivered and the way in which people want to receive their insurance products. And that's not just in terms of buying on mobile, which in our space probably isn't as relevant, but more about the structure of the products, the timeliness of the products. The underwriters then also work with the capital providers, and the capital providers have trust in us because we're providing them with information frequently and transparently. They can, in effect, look through the lens and look through the MGA at the kind of the data that we're receiving and the kind of risks we're receiving. And we work with those capital providers. Nick, I hope you put your hand up earlier. We do work with those capital providers to actually create products that we see a demand for and we're seeing a demand for at the time. And that's where the transparency and trust comes in and is actually beginning to add value into the value chain. So I think I'm echoing here what a lot of other people have said, which is really, I don't see the role of the MGA changing. We're still matching risk to capital. Everyone's talking about efficiency, but I see efficiency as being the byproduct of the process. In fact, what we're trying to do is build trust through transparency by sharing data and information in a timely manner and letting people look through the MGA and see the business that we're seeing. And I think that puts the MGAs in a very strong position to evolve as the market evolves. I think partnering with the right people so that you don't necessarily head off on a technological flight of fantasy just for the sake of doing it, but rather looking at areas which will generate a commercial benefit and allow you to be commercially aware and deliver those sort of products that are needed at the time that they're needed, is still very, very relevant. And I think the technology and the change that's happening at the moment positions us perfectly to deliver that. And that's it. So I'm going to pass back to Peter.
Great, thanks very much. I think we have time for a few questions before you are released into the wild. Please do wait for the microphone to come to you. Can I invite some questions, please? Stunned into silence. Well, I'm going to ask one. So it's a question for David, I think, mainly about distributed ledger technology, blockchain. I mean, we've got a number of proof of concept stuff out in the market at the moment.
Yeah.
When do you think the first sort of industrial strength application will be around, and where do you think it will appear?
So I imagine most people in the room will be familiar with the recent use of blockchain with Maersk, Willis, Amlin and XL Catlin. Is that something that most people in the room are familiar with?
Nodding, yeah.
Yep. So I think actually we're already there. I think it is already a practical implementation of it. I think that there will be lots of other smaller proof of concepts going on for the next few years. And as I said, I just think that in the MGA space in particular, echoing what Stefan was saying about yourselves being in this incredibly advantageous position to share data with all of the other participants in the process, blockchain could be an important part of the mechanism for doing that. Wider adoption of blockchain across the market in terms of central settlement and processing is probably a bit further off, but certainly those specific focused targeted uses of it now and in the next few months certainly.
Firstly, thanks very much for the presentation. A lot of the focus of what we've heard today is on the distribution, the pricing and the interaction between the MGA and the carrier. But just coming back, I think, to the point that some of the topics that Charles was talking about regarding the customer journey. Obviously, one of the biggest customer aspects of the customer journey is the claims process. So I just wondered how all this integrates from a systems perspective with the claims experience and the claims data, and the whole customer journey from that perspective.
Who wants to?
Sorry, that's not aimed at any particular person. So
No, I think it's a great question.
So, did you want to speak to that?
Not particularly. That's a complicated one.
Make it simple. I think. Oh, sorry. All right. Sorry, Charles.
Oh.
Yeah, I mean, I think that in my experience, quite often what happens is that the main focus is on the distribution and on the efficiencies in that area. But we also must recognise, that you're absolutely right. We need to be handling the claims efficiently too. So, is this data all flowing through to our claims providers? And I think it's easy to do that in-house. It's very, very difficult to do it, when we're using claim TPAs and things. And certainly what we're seeing is more integration of data flows to those TPAs. But is that behind, the upfront, the data integration between the MGAs and the carriers? Absolutely it is. Does it cause issues with claim servicing? Yes, it does. And is that an issue for Lloyd's in our market? I think totally, it is. So I do think we do forget that, and I think it's an area we've still got to do a lot of work on, because this data needs to flow through to the claim TPA, so that when the customer calls them saying, I've got a problem, it's not, oh, hold on, I'll have to get back to you tomorrow when I've found out whether you're covered or not. Or, I tell you what, I'll send a surveyor out now, but I don't even know if you're covered, so you might not even be our customer. And how many times does that happen at the moment? Well, rather more than we'd all like to think.
But from our perspective, we work closely with the TPAs on the lines of business we have. They actually have access to our system, so we tend not to have those kind of are you, aren't you on risk conversations. And also we are loosely integrated, by which we mean file transfers and those sort of automated feeds into our policy admin systems to then track the claims. But obviously in the London market we have ECF and all of those good things as well, which we're using internally to and across the market. So I echo what Charles said, which is we're possibly there or thereabouts with loose integration, but we're definitely behind the production pipeline.
Yeah, thank you. I think that was probably the two main points I wanted to touch on, because I think at the front end, I think from our experience, we've seen that there's a lot of focus on, from a customer perspective, on the purchasing of the policy, and the journey is all very smooth and digital, etc. But that doesn't always follow through to the back end when they're actually making a claim. Not quite so smooth and digital in some experiences. And then obviously the other side of it is the point you're alluding to, is how that data, particularly when you're outsourcing claims handling to TPAs, how integrated is that data and accessible within the system. So thank you.
Satisfied? Very good. I'm going to hand over to Jane from MGAA, please.
I'd like to thank you all very much for coming in and giving this talk. I think it's been very interesting. You will be receiving a feedback form. It's just a survey one can take 2 minutes, which will come to you either today or tomorrow. You could complete it, because CII look at these things when they accredit our events, and all of these events are accredited for an hour CPD. So I'd like to thank all the speakers, and also to just say, have you all registered for the conference yet? 12th of July, and you do need to register. We need to have a handle on numbers that are coming. We've got 80 exhibitors in the exhibition, and it's looking to be our biggest investment yet. So thank you very much.